Arindam Ghosh, Chief Executive Officer of Blackridge Capital Advisors, joins us live. Arindam, good morning. Thank you for joining us. We are in a spot of bother. Everyone is running for cover, and excepting IT, I guess there is no space to hide.
Yeah, morning, Nikunj. I think as you rightly put it, clearly what we are seeing right now is that whilst some of the leading developed economies like US, including Europe, they are kind of on the mend. We have seen a fair amount of recovery kicking in US, some amount of stability emerging from the Euro region as well, fair amount of policy action which is happening in Japan. But I think overall, the emerging markets actually are under pressure. I think there is a fair amount of portfolio rebalancing which is happening. So I think fund flow will continue to remain under stress. And overall, I think this risk-off environment is going to continue. So within that, we would have, obviously, we've seen a fair amount of capitulation which has happened in the mid-cap space. And the spillage, obviously, is expected to get into the large caps as well.
And for a while now, we've been floating around 5,500 to 6,200 thanks to just a handful of nifty names. After a sub 5550 close yesterday, I mean, the question really is how much more weakness to go? 5%, 10%? What's in store for the market?
No, clearly, in the past, and that has been our consistent view that the markets had run up excessively, and obviously the economic fundamentals really did not justify. So I think there is some kind of catching up which is happening on the downside as far as the markets are concerned. I think what would be the biggest risk is how typically the fund flows, both in terms of inflows and outflows and net flows actually play out over the next 6 months to 1 year. We all know that the tapering of QE is inevitable. It's there. The writing is on the wall, so it will start happening. But the issue is there is a fair amount of uncertainty around that, both in terms of the timing, the quantum, etc. So I think typically from India's point of view, a clarity around any of these two variables, I think would be extremely important to kind of get some sanity restored in the market. In the run-up to that, I think over the next 2 quarters or 3 months, we would see a fair amount of volatility coming into the market. But again, I think on a 1 year, 2 year perspective, we all know the interest rate cycle has actually now turned. And according to us, probably it will take about a good 9 months to 1 year, for the interest rate cycle to again change. So till then, I think there is going to be a fair amount of weakness in the markets. Markets are going to remain volatile. They are going to remain choppy. And I think from here on, we may see the markets going down. The downside risk basically to the market continues to remain high.
Do you think Nifty could go to sub 5,000 levels before it bottoms out, which is another 10-11% from here?
Nikunj, I mean, without getting into index numbers, I think overall, if you see, the downward momentum is quite strong, and I think that's going to continue to remain the trend till we see some kind of confidence coming back into the market. The expectations from the market at this point in time are extremely low. So I think that is a big opportunity which we must not miss out, whilst we get clouded with so much of negativity and pessimism. Nobody's expecting right now anything. I think the policymakers have been doing whatever they can do best in terms of various measures that have been unleashed or WIP. But all that is going to take a little longer while. I think we have extremely competent people in charge of policy making at various quarters. So those, I think, are given. Now, what needs to be seen is how well they actually get transmitted. We must not forget that we are in a situation where corporate balance sheets are coming under serious pressure because of the interest rates going up. And obviously, companies are getting more leveraged, and with that, the cost of capital, etc., goes up. So you have margins which are coming under pressure. So I think the next couple of quarters are going to remain extremely challenging. But having said that, I think over a 1 year, 2 year kind of perspective, things may start to improve. Now, definitely, the developed economies, the sense is that the second half is going to be an even better second half than the kind of improvement that they have seen so far. India may not be able to pull through a very good second half recovery. But going forward, I think the next year fiscal should be a time when things should start looking a lot better.
Do you think the biggest risk for Indian markets in the short term now could be consumer names? They're trading at lofty valuations. Everyone was buying into consumer names because they gave you a cushion of earnings visibility. But if economic conditions are likely to deteriorate in the short term, consumers will slow down and these lofty valuations will not sustain?
Clearly, that seems to be an obvious trap. I think the way the entire sector rotation has actually played out, people have actually scurried for cover. They have actually gone into these defensives, and obviously FMCG has been there leading the pack. Valuations have actually run up, obviously in a period of slowdown like where we have seen growth almost halving. We are already seeing the volume growth for these companies coming under pressure with its resultant impact on margin. We've seen a fair amount of, I would say, pressure starting to build up on some of these counters. And the sense is that whilst these companies are individually extremely strong, well run with very high standards of corporate governance, obviously valuation at these levels can clearly not be justified, and probably we will see going forward some kind of a correction and more deeper correction coming in this sector as well.
Mm-hmm. Arindam, how big a concern is the currency? Because any step by the RBI to defend the currency doesn't seem to be working, and you've got it making life flows each time.
No, that continues to remain the biggest threat. I think we've seen the policy from the central bank clearly being dovish. I think whilst they are trying their best to kind of control the currency, I think they've been successful in bringing down the volatility. I think that was the first task from the central bank. The next step would be to try and see what really is the real level of the Indian currency, and the sense is that the currency may actually be in our interest, looking at where we stand in terms of the current account deficit, be allowed to kind of drift without it letting to really go off the handle. So the sense is that somewhere around 62, 63 are also levels which can be touched, and probably we would let that happen gradually over a period of time, as long as we are able to contain the volatility and take the speculation out.
Arindam, do you think the long IT trade is getting slightly not crowded but overcrowded? 10 on 10 brokerages are recommending their clients to buy into IT, and that is the only pocket where money has moved in and money has not moved out of late.
I think it's almost the same kind of a story that we have seen getting replayed, as far as IT is concerned, what we saw in FMCG. So clearly, in a situation where currency has actually been supporting this sector, and probably as I said, there could be some length for the rupee to go down further from here. Obviously, these sectors which are clearly export-led, stand to be the biggest beneficiary. To back it up, you have basically in the US markets, which have actually been doing extremely well. Corporate balance sheets there are extremely strong, they have got repaired. And I think the windfall is that now UK, we've seen the recent data. If you look at the car sales, the factory output, they are showing signs of good recovery. So if the Eurozone also stabilizes, I think it will be a further boost for many of these IT companies. So overall, I think in a situation where developed economies are doing well, this sector probably is going to do better. So and rightfully, therefore, we've seen rotation of money moving into the IT sector again. We would probably end up with a situation where in a market like this, which is so narrow, that too much of residual money chasing too few stocks, which again is going to make the valuations look unrealistic beyond a point. But till that happens, I think there is some room to play around.
Right, Arindam, appreciate the time and thank you for joining us.